fast cuts of Wall Street trading floors, historical fraud headlines Madoff, Enron, then a transition to the host, Ahmed Daud, in a professional studio. Ahmed Daud, in the world of global finance, trust is the most invaluable currency, the foundation upon which every trade, every investment, and every growth story is built. But what happens when the promise of swift riches turns out to be a fragile illusion, meticulously designed to siphon capital from committed investors? From the corporate collapse of Enron to the spectacular fall of crypto giants and the devastating fraud of Bernie Madoff, major financial meltdowns serve as stark reminders that organized crime still often operates behind polished corporate facades. Today on Moon Market Update, we are pulling back the curtain on global investment fraud. We will dissect the mechanisms that allowed international scammers like Madoff and the operators of the infamous Stratton Oakmont boiler room to steal billions. We analyze 3 enduring models of financial deception: the Ponzi scheme, pump and dump market manipulation, and the pervasive pyramid scheme. Crucially, we'll equip you with the knowledge to recognize the red flags and become your own first line of defense. Bernie's $65 billion stake at Debernie's name is synonymous with fraud and betrayal on Wall Street. This former Nasdaq president led a massive financial scheme, manipulating investors and draining them of an estimated $50 billion to $65 billion over decades. His operation, Bernard L. Madoff Investment Securities LLC, promised investors a split-strike conversion strategy, a complicated and secretive approach generating consistent double-digit returns. But secrecy was the fraud's defining feature, meant to hide the truth that no actual trades or investments took place. Madoff's scheme was ruthless and deceitful. He funneled client funds into a single bank account without actual purchases or investments. As investments continued to grow without real market success, fresh capital was constantly drilled into the system. Meticulously falsified financial statements, created in-house, presented as legitimate investments. Despite numerous red flags, regulatory oversight failed to catch Madoff's deception. A critical oversight was not investigating counterparties and supposed transactions, as every genuine stock purchase requires a seller. Madoff's fraud remained hidden because trust in his appearance masked deeper lies in regulatory oversight. The scheme's fall came as a result of the 2008 financial downturn. With global economic difficulties, investors had a surge in redemption requests. Madoff's business lacked the funds to pay for these returns, leading to liquidity issues. This lack of funds exposed Madoff's fraud, as the world was quick to realize the trickery behind his elaborate scheme, especially with his high-profile involvement. Madoff paid a huge restitution bill highlighting the devastation caused to thousands of individuals and charities. His story serves as a cautionary tale for always questioning trust and unwavering confidence in seemingly sophisticated schemes, making external governance crucial in any financial operation. Stratton Oakmont in the Cold of Greed. This passage describes a scandal involving the brokerage firm Stratton Oakmont, co-founded by Jordan Belfort and Danny Porish in 1989. By promoting a highly speculative pump and dump operation, the firm was notorious for its ruthless and unchecked greed during the 1990s. The culture of the company was designed to maximize profits for the founder and associates, prioritizing manipulation over ethical conduct. The operation started when Belfort and his partners secured wealth through underwriting initial public offerings at POs of stocks such as Master Glazier's Curated International. By controlling the market or dictating the price, they could manipulate outcomes and gain significant profits. The next phase involved the aggressive pump, where brokers convinced unsuspecting investors to buy the shares immediately, under pressure from fear of missing out FOMO and insufficient diligence. Although the company had some internal failings, including an active involvement in fraudulent activities, this allowed the business to survive and expand, ultimately resulting in widespread financial loss and loss of trust in the system. In response to the scandal, the National Association of Securities Dealers and ASD took legal action against the firm, finding patterns of excessive pricing and a lack of fair practice. In 2006, Stratton Oakmont was expelled from the NASD and faced criminal charges for fraudulent activities involving over $200 million in lost principal. The Stratton Oakmont case illustrates the dangers of unethical business practices and highlights the importance of maintaining trust and transparency in the financial industry. The advice remains relevant: steer clear of hype and unsolicited cold calls, and always exercise caution when investing in unverified stocks or digital assets.
Herbalife Paradigm Multi-Level Marketing. Herbalife International of America, Inc.'s case is notable as a regulatory intervention against a pyramid scheme, a common MLM structure. Although MLMs are not illegal per SE, the FTC charged Herbalife with deceptive practices, specifically focusing on the compensation structure. The FTC's focus was not on product quality, but on Herbalife's misleading consumers about their potential income through a multi-tiered marketing program. The promotional material often spoke of the business opportunity as a route to financial success. However, as uncovered by the FTC, the majority of distributors made little or no money from their involvement in the business opportunity. Over half, on average, earned less than $5 per month from product sales. The key payouts were through commissions generated by sales made by their recruiting customers. This shifted profits from actual consumer demand to internal purchases, violating federal law. The high rate of distributor abandonment further demonstrated the unsustainability of the model. The resulting $200 million settlement was unprecedented, requiring Herbalife to not only pay redress to consumers but also restructure its U.S. business operations. The central mandate of this restructuring was to align rewards distribution with actual retail sales, eliminating the recruitment-based incentives. The order had two main changes. At least 2/3 to thirds of rewards must be based on verifiable sales to end users, and 80% of company net sales must be from legitimate end-user sales. If this model does not meet these targets, Herbalife must significantly reduce rewards paid to high-level distributors. To ensure compliance, the settlement required Herbalife to hire an independent compliance auditor ICA for 7 years, reporting directly to the FTC, and banned misleading or unsubstantiated claims about earnings or lifestyle. This landmark case established the crucial role of consumer demand in an MLM model and reinforces the importance of regulatory enforcement to protect consumers from economic injury caused by unfair practices.
Final recommendation: do your research, refuse to be rushed, and demand absolute clarity on the source of your returns. If an opportunity sounds too good to be true, it most certainly is. If you want more in-depth analysis of market challenges, click here for the next video in this series. And most importantly, make sure you subscribe to Moon Market Update for our weekly market and regulatory insights.